Good afternoon, everybody. There goes the closing bell, and it's time for our Selecting an Option Strategy webcast today. I'm Connie Hill. I'm happy you would join me here today. In this webcast, we talk about a lot of different strategies and how they might fit in with our current market conditions and have some discussion. Last week, we had a discussion on trying to simplify the signals, right? We talked about just using 2 moving averages for an entry and for an exit. Now, I'm curious how many of you experimented with that a little bit. If you did, I want you to chat it into me. Let me know that you have experimented with that. There were a few lingering questions about that, and so we're going to pick up on that, kind of start there today, and then we've got a second part of our session here today we're going to dedicate to answering, or actually, responding to somebody's request from a survey, okay? We always appreciate it when you take the time to do those surveys, and so those are some things I like to incorporate in, so we're going to do that in the second half of our session. I am joined in the chat by Cameron May. I'm glad Cameron's here, fellow coach and experienced veteran of the markets. As you have questions, go ahead and chat a bit. I'll keep my eye on the chat, but Cameron may have to catch some things that I can't quite get to. All right. I hope you're following both of us. I'm Connie Hill CS. Cameron is Cameron May CS. It's free to follow us, and we'll put out some educational content throughout the day. I like to put out some different chart types of things, search results, things that I think you might find interesting. I like to share with you. All right, let's get going here. Let's go through our disclosures and start on our agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and informational purposes. Don't consider it a recommendation. We will be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool if you're trying out different strategies, different rules, to do it out in your paper side, and then when you're ready to implement it, go over to your live site. It's a fantastic tool. Past performance of any security or strategy does not guarantee future results or success. When we talk about probabilities in this class, they're theoretical in nature and never guaranteed. All right. Now I am going to come over here and see if any of you practiced a little bit with that 520, 5 moving average crossing over the 20 moving average in terms of trying to simplify if you feel like you get analysis paralysis and you just don't know what to do on the chart. I'm curious to know if any of you experimented with that. So go ahead and let me know. Upcoming events, we had our Market Drive event in New York last weekend. Great success. Several of you were out there. I saw Barb's ex. She had posted some pictures of some of you, which I think is always fun. So we'll be in New York next in August 8th and 9th for a workshop. Then in Chicago, another workshop. And then about a month later in Washington, D.C. for the workshop. And these are all going to be technical analysis and option strategies. Now, you don't have to live in that area to go to it, okay? If you want to visit that area and fly there, you certainly could do that, okay? Just register, because things are filling up really quick. Some of our events we have scheduled out a little bit further out are booked, is what they're telling us, okay? So if you're interested, do so. All right. Typically, we take a look at what the market conditions are, what they're doing, and then we talk about strategies that we might consider in our webcast or in our portfolio, what we might want to add to it based on those conditions. We always look at a lot of different examples, of course, on the platform, some existing trades and some new examples. Today, we're going to kind of follow up with that 520 crossover that we talked about for the first part. So let's go there. Last week I talked to you about, if you're getting analysis paralysis and you're looking at the chart and you see support and resistance and price patterns and different studies, MACD, stochastic, price patterns like a flag and a breakout, all those things, you might just be feeling a little overwhelmed with everything that you think you're supposed to look for on the chart or the things that are jumping out at you. And so we just took the idea that if you took a 5-period moving average and it crossed above a 20-period moving average, both of which are kind of shorter time frames, but certainly 5's really short, that some people might want to use that for an entry signal and stay in a trade until you get the crossover to get out, 5 crossing down below the 20. So let's go look at a couple of our trades that we did from last week based on that 520 crossover. And then I want to bring in somebody's question that they raised about that we didn't have time to get to last week. Quick look at the markets here. Dow was the big leader of the indexes today. Looks like it not quite 1% up, but about 500 or 400 points up. It looks like it was at the end of the day. The last time I checked, the SPX had been up and then it pulled back. Let's go SPX here real quick. And then we'll have, let's see here. Looked like it pulled back a little bit here towards the end of the day, so it didn't quite squeak out a gain here. Just a tiny bit of a loss. And the NDX, it actually was fairly negative most of the day. I mean, it rallied up off of its lows, but didn't really, it wasn't as strong as some of the other indexes. Okay, could there have been some profit taking? Yes. I did want to point out to the bottom study here. This is the Market Forecast Enhanced study. And we've talked about this a little bit in the past, and sometimes we like to use it when we're looking at maybe identifying our posture for the market. And so what we're seeing here is this intermediate green line. The intermediate trend is up here in the upper reversal zone, which means it's strongly bullish. And I'll look at the number and see what the number is. It looks like right now it's 95 and falling. But, you know, anything that's over 80 will still consider bullish. Anything that's over 90 will consider very bullish. Okay, so I would say, yeah, it is still in a strongish bullish area, even though, yeah, it pulled back a little bit today. If we go back here for the SPX, it's up here in that upper reversal zone. Let's see, it's right now at 96.84. And this will show you if it's falling or rising. And it is falling, I'm going to say ever so slightly, but yeah, strongly bullish. All right. Volatility index, we won't use the market forecast study for that. But as far as volatility goes, we're back down into some lower ranges, right? When we're back down in lower ranges on the volatility index, typically, what does that mean for option traders? Okay, what is that going to mean for you as you look at the chain? Well, generally, maybe prices are not going to be so hyped up. Maybe they're going to be a little bit lower because volatility is not quite so high. But when we get in periods of time when volatility really spikes, we'll see a couple things. We'll see option prices expand, which can be beneficial for some strategies. And we will see, many times we'll see it's the spread of the bid and ask price go out a little bit from each other because they're trying to account for the volatility. Okay, so we want to be aware of that. Now, looking to see how many of you tested that a little bit, it looks like Ricebird is letting BJ know you did that and you're testing. Was that with the 520 crossover or was something else? Might be with something else that you guys are talking about. That's all right. Ricebird says, you know, after we go through all of this, maybe we just take a dart and throw a dart to select our strategy. No, we don't want to throw a dart. We can be a lot more pointed than that. Okay, you get the feeling in terms of the outlook. Market still is fairly bullish. I actually think it's a little nice that the Dow is starting to kick into gear because it has not been one of the stronger indexes. Today it was a leader. We go to our DJI. Yeah, it was the leader from the get-go today. It has not been creating new highs like the NASDAQ and the S&P have, but what's it doing? It's closing in on its high from out there in January. So it's getting pretty close there. We'll see. Maybe it'll hit there tomorrow or the next day. All right. Let's take a quick look at our two trades that we did on our 520 crossover from yesterday. Okay. Let's head on over here. And we've got a lot of trades that we're focusing on in our class here. The two trades that we did last week were with Abbott and with Wells Fargo. So they happen to be the bookends on our list of trades here. With Abbott, we can see it looks like it's down a little bit, down 155. We took a crossover of the 5 going above the 10 or the 20. on this. And instead of buying stock, because this is an options class, we did something different. We said, well, what's something that could in some ways, not in every way, but in some ways be a substitute for the stock, okay? That would be what we went with was a long dated option. So this one's out in January. And the idea here is, man, if that 5 stays above the 20, we want it to have some time to ride and see how long it could go. It might last a week, it might last 3 months, might last 6 months. We just really don't know. So we wanted to buy a lot of time for that. And so, yeah, it's down a little bit. We paid $12 for it. Now it's down to $10.45. How do we determine if we need to be out? Well, we're going to use the 520 crossover, okay? Let's go back to the charts here. Let's bring up Abbott. And I am going to get rid of the market forecast study here, that enhanced. I just only wanted to use that with our indices here and kind of clean up the chart a little bit. And here, let's see, let me give us our 520 now. Let's go find it. We've got 520 crossover. All right. Pink line, a little faster moving line, that's going to be our 5 moving average. And this this bluer colored line, that's the 20 moving average. So last week we got in when they crossed. Here was our signal. It was quite a strong candle day for Abbott that particular day. Market was closed because that when we have our class, the market's closed. So we put in our order to get filled the next day. But the actual crossover took place here. Okay, so we got filled on our order. It's pulled back a little bit. It's run up a little bit the last 3 days. Overall, we saw on the price, we're down a little bit on the trade. But the 5 is still up here. And the 20 is still down here, so they haven't crossed. So that means we don't have an exit signal. And that's all we're looking at. Just those 2 moving averages. We don't really care if there's resistance at 136. We don't really care if there was a price pattern. We're only focusing on those moving averages. Okay, we'll actually come back to that. The other one we did was Wells Fargo. WFC, kind of a similar type thing, except that we got in on the crossover, which technically occurred here. Tuesday of our class, we got in Wednesday, and this one's continued to go up. And so this one you can say, oh yeah, the 5 is way up there. It's even further from the 20 than it was when we got in. Okay, so the 5 trending quite strongly. And so on this particular trade, as we come down here, it looks like we're up a little bit here, right? We're up about $207 on this particular trade. Now, I want to go to answer somebody's lingering question from last week that we didn't have time to get to. We talked about, I should show you in Wells Fargo, it's also a longer dated option. It's that January option, so lots and lots of time. We're treating it like a stock. We bought the first strike price that had a delta of at least 0.6, okay, because we were trying to look for some intrinsic value for this option. All right. The question came in that said this. On the 520 SMA crossover on Wells Fargo, we traded the 75 strike price, that long call, in January. How would selling a 75 put with the same or shorter term expirations affect the trade? All right. If we were to sell a put to go along with our selling or our buying of a call, we're putting on a very bullish trade, aren't we? Yeah. We'd call it a synthetic for stock. Synthetic really means kind of substitute. You know, if you have synthetic leather, something like that, it's kind of a substitute that mimics real leather. You might not agree with that it's really leather-like for you, but that's the general idea, right? If we were doing something that's synthetic. And so what would happen in that scenario? Well, let's just kind of assume we did. Let's assume we bought a call and sold a put the same day. The value of the call's gone up a little bit, right? It's gone up from 8.95 to 11, a little change. If we saw that same price action on Wells Fargo and we had a short put, what we would likely to see here, we didn't do the trade that way, but basically would have brought in a credit, and we would hopefully be seeing the value of that put diminished as the stock goes up, right? Because put values drop when the price of the stock goes up. So we would probably be sitting on a very bullish position. And really, it's up to you to decide what strategy you think might work best and what strategy you're comfortable with, what strategies you have some good rules for, right? So it's not to say we could have only done a long call on this one. In fact, maybe even doing that as a substitute could have been entirely appropriate. Okay, I appreciate the question. I don't remember who it was that asked that, so I hope that you're still here. Okay. Looking in the chat, looks like we have a survey. All right, you guys, from time to time, we'll put out a survey in the chat. Actually, Cameron and I don't do it. Somebody else does it, all right, that is keeping track of the surveys. And in any case, we always appreciate your feedback when you select on that link and fill it out. Now, we're not done with the class yet today to give feedback on it necessarily. But if you'll click on the link so it's active and in the background, then when it's time for you to leave or close down the class, you could go ahead, fill out that survey. Anything you submit, I will read and our managers will read because it's important information to us. And I always encourage you, and some of you did last week here, or last time, gave me some additional information of things you wanted me to maybe talk about, whether it's something you're struggling with or, you know, even this particular question came in at the end of our class last week, but that could have been something somebody could have put in the survey as well for me to incorporate. Now, the second part of our lesson, I am going to incorporate a suggestion or an ask that somebody had. So just know we appreciate you taking the time to do it. It's really easy, 2 bullet points, pop, on a scale of 1 to 10. And then if you want to respond to 2 other questions, you can, or use that real estate to send me a message, okay? Just one other way you can connect with us, all right, and share some information. All right, let's get to, I hope that answered the question, whoever that was that had the question about Wells Fargo. The second part that we're going to talk about here today came from the survey it actually came from my short verticals class, but I imagine you might attend the short verticals. But the question and the ask was really appropriate for this class. Okay, let me read it to you. Somebody said, I would really like a class on when to use what option strategy. Hey, this class, right? For example, I use an iron condor on sideways moving stock or prior to an earnings report. This is theirs. When is a diagonal best to be used? I think that would help a lot of us. So bingo, we're answering the question or the ask in this class. Okay. And so what I'm going to do, I want to answer this question actually in chunks. And I think you'll see here in just a minute when I bring this up. These are the main strategies that we talk about in this class, right? We've got our bullish, our bearish, and our neutral. And as that person mentioned, you know, maybe doing an iron condor. They said, you know, prior to an earnings announcement, which some people could, but you could do a lot of these prior to an earnings announcement. We're going to start here because we're really in more bullish conditions, so I want to consider it before we go over to the bearish. There are 2 things that you might want to consider when you're trying to decide what strategy might be best. Okay. First is, what do you think the price is going to do? And the next is, what do you think volatility? Well, that volatility, what's the volatility going to do? Well, on this first column, we're hoping the price goes up in every scenario, right? But some of them are going to be more advantageous if volatility is high or volatility is low, or we think volatility is dropping, or we think volatility might be increasing. Okay, so let's talk about that on a long call. Clearly on a long call, you want the price to go up. But is it going to be better for the long call if volatility goes up or volatility goes down? I want you to answer that to yourself. Is this going to be more beneficial if the volatility goes up or volatility goes down? Well, we want that price of the option to get bigger, don't we? So if volatility rises, yeah, we would expect that the premium is going to swell a little bit too. That's always very helpful if you're a buyer. Okay. What about a cash secured put? Obviously, price going up. You have the cash sitting in your account in case the stock is put to you. If a stock's put to you, typically it's in a bullish scenario, right? You're taking ownership of the stock and you think the stock is going to go up. What about implied volatility? Would it be better if it were going down, or would it be better if it were going up on a cash secured put? What do you think? You can kind of answer to yourself. Okay. On a cash secured put, we're selling the premium at the very beginning of the trade. And so if it were to, volatility were to drop on it, if volatility were to actually, might have to redo that one. Okay. If the volatility drops on a put that we've sold, is that helpful? Yeah, that is quite helpful actually, right? Because the premium shrinks down. We sold it at X and now it's lower than X, right? If the volatility value is dropping. Now, I might have confused you a little bit on how I refer to the volatility here. Volatility, we'll use beta as far as what's the sensitivity to volatility. And if it becomes more volatile, then the price of the option actually goes up, which would not be beneficial in the price of a put. It's only if the value of the put drops. Okay, so implied volatility, likely it could go up, but ideally we'd maybe want it to drop a little bit. Okay, now what about a long call vertical? Well, we have a long dated option, kind of like our long call here, and then we always have that option in the same time frame, but it's usually a little bit out of the money, the one that we sell there, right? We kind of think of it as possibly a little bit of a hedge. It looks like it brings in a little bit of premium that lowers the net debit on the cost of the trade. Okay, because the bigger leg or the option that has, I'm going to say, more relevance to the trade is the longer dated option, then we'll go with the idea that maybe going up on the volatility would be better slightly, okay, because it's going to help the option that's longer dated. It's going to hinder the option that's shorter dated, but the shorter dated, or not dated, shorter dated, the shorter out of the money one, the one that's further out of the money, has less impact possibly on that volatility. It's not going to be quite as big of an impact. Okay, and when you're looking at this, you can go out to the Greeks, right, on the option chain, and you can pull them up and you can play around with that using the Theo price calculator. Okay, what about a short put vertical? Okay, it's going to obviously bullish. We want the price to go up. We're selling a premium, but if volatility goes up, that might hurt the bigger leg. The bigger leg, meaning the one that has the most impact on the trade, is going to be this short put that we sell. And it's the long put that's just kind of our little bit of a hedge and not as big a component in the trade. All right. A call diagonal spread. Usually on this, there's two ways you can structure diagonals. Okay, they can be short, they can be long. Many times when we're referring to this call diagonal, typically we're going long a call and it's longer dated, and then shorter time frame we're selling, say, a call to lower the net debit. But overall, the leg that is the bigger factor is going to be that longer dated one. Okay, and so we would love volatility to go up a bit in the price of that option. Now, if it's a call and we're expecting price to go up, volatility might not go up that much, right? Because usually volatility gets priced in the option when volatility goes up, right? Things get a little uncertain, a little bit shaky or whatever, uncertain, and the value of that option might creep up a little bit, which is kind of nice. So if you think volatility might increase, great. Then you might consider doing a call diagonal. Let's look at this last one because that kind of ties into a little bit of the question that we talked about the very first question about, we bought the long call. What if we sold a put as well? That turns it into a synthetic stock. So we've got two bullish positions, right? We want the stock to go up on both of them. On the synthetic of the short put, we kind of go back up to, the short put. It would be nice if it dropped. But on the long call, it would be nice if it went up. So because most of the time they are going to be very similar, because we're using the same strike price, they're kind of, for the most part, going to be offsetting each other, unless you set it up in a way that maybe the strikes weren't really at the money, that maybe you were kind of making it more of a short strangle or something like that. Okay, does that make sense? I hope this is helpful to you. Now, if we were to go through the bear strategy and the neutral strategies, doing that whole exercise, I think it might be a little bit overkill. Okay, so we're going to stop there for the moment. All right, let's go ahead. Let's clean up our arrows, and appreciate you guys doing some answering of those questions as we were talking about them. All right. Let's talk about possibility of some new trades. After we looked at the markets and the VIX, market still tends to be looking more bullish. There could be some scenarios that you might be looking at that you might be thinking maybe it might be a little bit time to hedge one of the positions. So longer dated options, you could maybe turn them into a diagonal by selling a call against them. Long stock positions, which we really don't do a lot in this class because we're working on option strategies. Yeah, maybe somebody might want to sell a call and or buy a put as some protection, which kind of gets into why might we buy a long put. Okay, so some stocks, they might be getting to that kind of a point if it looks like, man, they've had a nice run, they've hit resistance, they're rolling over. What I wanted to look at today was something that maybe had fresh entries as opposed to being real defensive. Although certainly timing-wise, if the NASDAQ's down again tomorrow, that may impact a lot of technology stocks that some of you might have. All right, we're going to head back here. We are going to go over here to our charts, and I'm going to pull up here Freeport-McMoRan, FCX. And let's also bring back our implied volatility. Where did it go? Let me just bring it back. It left when I brought over the 520 crossover here. So let's go imp vol, or just even V. Let's bring that in, implied volatility. Let's make it a little bit thicker so it's not so scrawny. Let's make it a 3 so we can see that a little bit better. And I do want to maybe back up a little bit here. Let's maybe say look at 9 months. Okay, we look at implied volatility on this particular stock, and we just talked about volatility and the role it might play. You kind of look at it over a little bit longer period of time, as say just a month or 3 months. Man, you look at that volatility and you're like, well, it's pretty low. Could it go lower? Well, it could, right? Right now it's at 0.38, it looks like. And if I come here to one of the lower areas, we've got 0.34. Let's go here, 0.36. So it's kind of in that same area where the lows have been, another 0.36. So yeah, it could drop a little bit, but it might not be a major factor, okay? Now, would you be really excited about selling something with that lower implied volatility? Or do you think you might be more inclined to do something with a buying strategy with lower volatility? Okay, you can answer that question to yourself or in the chat. Happy for you to go ahead and do that. I'm going to answer the question here. Yeah, probably more likely looking at something obviously bullish, but maybe doing some buying strategies. Okay, let's come over here to the trade tab. And let me get rid of that little guy. And on this, it traded over 9 million shares today. So that means probably these weeklies, we're going to find some activity in there. One I was looking at, because we can, is looking at these August ones. So we've got 31 days until they expire, right? a month from today being July 1st. Look at the open interest column here. We've got lots of contracts on a lot of the strike prices, not necessarily all of them. Lots on the call side, not so much on the put side. But if we've already said, we probably might not really want to do a put spread or sell a put on it, we might be inclined to do a long call or a long call vertical or something of that nature. Or if somebody wants to be very aggressive, they might be inclined to maybe do a synthetic stock where we buy a call, sell a put. Now, the prices of the bid and the ask are looking artificially wide to me. And I say artificially because when the market was engaged and going, I was seeing a much smaller difference between the bid and the ask. That's one of the things we run into in a class when we do after the market's closed is we see those bid ask prices spread out artificially. And then in the morning, usually what happens, the market opens up and the bid ask price kind of shrinks right back down, gets more into a normal range. So I don't want it to throw you off here going, oh man, 167 by 330, why are we looking at that? You could drive a Mack truck through that, right? Because it's really kind of artificial, but we're seeing that. 92 cents by 211, not normally are we going to want to do that kind of a thing, okay? So keep that in mind. Probably really isn't this wide. And in the past, when we've submitted something that did have something artificially wide, what I'll do is I'll go in the morning, the next morning when the market opens and I'm looking to make sure our orders get filled, I'll make sure that they have shrunk back to a decent bid-ask spread, okay? And so typically we're going to put them in at the midpoint price to help account for that. All right. On this, let's see, the price of the stock, would you look at that, closed at 44.05. Okay, what if we were to look at doing something we don't do a lot of in here, but what if we were to buy the call and sell the put? And just kind of see how much premium we could bring in that would maybe lower the price of the call option. So I'm going to hold my control key down as I click on the bid price here for this 44 call. And then we're going to kind of bring this down and I'm going to click on the buy price here so that we can see, hold the control key down still, so it brings them up together here and gives us a net. Well, I don't know that we're going to get a 45-cent credit here, quite honestly. It's interesting because the call price is really flared out. The put price is not as much. Okay, so we're really seeing a big impact there. This might be something that in the morning I'll kind of let them kind of shrink back down and then see what looks possible. Many times we will trigger or we'll target for that midpoint price, so we'll see what things look like in the morning. But it very well could be that we end up with a little bit of a credit or maybe a small credit or a small debit here, okay? Just looking at this, because both strikes are so close to 45 or 44.05, that's why those option prices, at least on the outside, are very, very similar because they're so close to the strike price there. All right, let's go ahead. Let's put this in. We're only going to do one contract. Now, whether we get a small credit or a big credit or a small debit, let's take a look at the risk profile on this, okay? Come up here, we're going to do Analyze Trade. And I'm going to hide any positions. Okay, I'm going to get rid of this one. That was an old one. And in the risk profile, what I want you to see is that where does our max loss kick in here? Okay, where does our max loss kick in? Well, basically the stock going down to zero, right? We sell that put and we're not hedging it like we would if we were doing a put vertical. And so the loss could get really big is really what I want to show you here, right? Do we expect FCX to drop to zero? No, we don't. But theoretically, we could put the stock at a penny. And so it has to do that calculation for us. But if it was something that maybe we were just looking for maybe a bump, a quick move, yeah, we might be interested in that. If we go back to the chart here, the one thing I wanted to show you here is kind of what the technical setup was, because it had a nice breakout popped above here, kind of gave it a little retest. And what's it doing right now today? Bouncing up off that, what was the old breakout area, should be support. The other thing we have going on here is a price pattern. I don't know how many of you look for price patterns, and this one is one it's not perfect, okay, but it is an ascending triangle, which basically means the top points getting hit here are the same, and then the low points keep getting a little bit higher and a little bit higher, okay? The reason why I say it's not really ideal is it would have been nice. We didn't get it, but it would have been nice if maybe the price had gone up here a little sooner than it actually did over here. Okay, maybe at that point running back up, or at this point running back up, would probably make for a stronger triangle and a stronger breakout area. It didn't, so we can't cry about it. We take what we get. Somebody might be interested in this at looking at a pretty long move. They could look at this as saying, okay, on ascending triangle, let's go to the second point in. Here's the first point in the triangle. Here's the second point in the triangle. And so I'm going to use that diagonal line and go straight up, about as straight as I can get, to see how high, what's the height of that triangle. It's saying it's about $9.50, okay, or 28%. That's really quite large, okay? The expectation is that after it breaks out, that the next major target it might go to is about the height of the triangle. So looking at this, somebody might say, oh yeah, well, let's maybe just do something that might take a bit of time to get there, okay? Or somebody might say, I'm not going to hold on to it that long. I've got a short put, a long call. If I get a big pump, a boost, and we get a real quick payoff, they might be inclined to get out pretty quickly, okay? So they might not go for the whole target here. If I duplicate that and I come and I drag it here to the breakout zone right here, and I pull this back, that's saying maybe a target up there. Let's see how high that goes, to 53.40, okay, which is a pretty tall target, okay? We're not going to go for that big of a target, okay? We're going to see if we can get a little bit of a move that is significant enough that we're happy with the gain. Okay, hopefully the stock moves up quickly. That would help the long call. If it dinks around a little bit, well, our short put, that'll benefit it, but it'll benefit both of them more if it'll go up. Okay, what if we were to put in a kind of a smaller target here? We could go, we could go half the distance of maybe what this breakout is. We could do even less than that. I'm going to say my midway point here. Let's go to 48.50. Okay, I'm going to write that number down. 48.50 is just kind of ballparking it, looking kind of at the lower, kind of almost to the midpoint here of the height of what maybe the bigger target could be. Okay, so we're going to put it in that way. What about getting out? Because if it goes against us, then we're going to have the two positions working against us, right? So somebody might say, okay, if it does not really honor this breakout, it looked like it retested and bounced, but if it really falls back down in here, we probably ought to get out, right? Because we have a very bullish, we've got a synthetic stock situation. We want to give it a little wiggle room, okay? We don't want to stick it like right there, right below the line, but maybe something in this range. Maybe if we go down to, say, 42.50. Okay, if it goes down to 42.50, we want to be out. But if it starts climbing, inch up the stop loss based on the price of the stock. Okay, this is not the only way that you could do this. You could do it based on option prices. You could do it however you want. But let's try this to begin with here. All right. So on our trade tab, we're just going to do one contract. Let's do a first trigger sequential. Let's create an opposite order. And here on our opposite order, let's go ahead and make it a market order that's going to be good till canceled, and then put in those two prices for the condition here. So what we're going to say, we want to close both legs. If FCX gets greater than or equal to, first number is 48.50. All right. Or it gets less than 42.50, or whatever number you feel more comfortable with on either of those targets or stops. This 42.50, the idea would be if it bounces tomorrow, moves up a little bit, we're going to cinch up. This 42.50 will still leave the 48.50 in place, but we'll, hopefully move this up to 43.50 and 44.50 and so forth. Okay, let's make sure I've got my triangles going the right direction. So greater than or equal to 48.50 and less than or equal to 42.50. Okay, we're going to hit save on this. I'm going to send this little guy in, putting in our option strategies bucket. Again, I'm going to watch that tomorrow. Make sure the bid-ask spread really narrows back up, and more likely than not, I'll need to adjust our order for whatever the price is trading at right then. All right. Chris is saying to Lawrence, have you noticed that the bid-ask spreads widen later on those, or do they pretty much follow the rest of the option market on that? That was addressed specifically, I guess, Chris, to Lawrence, maybe conversation you guys were having. But sometimes you will see that. You'll see the bid-ask spread, these orders come in, and it just kind of spreads them apart where there's a lot of activity. Okay, so you do want to be aware of that. Have you guys become subscribers to the Trader Talks channel? I sure hope so. If you do, it sure makes it easier for you to find our content, and we are kind of doing some updates to this page quite frequently. Okay, you can, if you're a subscriber, you get this kind of a view, and you have some nice things to pay attention to here. So obviously our class right here is going on now. This is the last class of the day, so tomorrow morning we'll have Trader Talks in today's market. Kevin Horner is going to be there. Start the day out with Kevin right at the opening bell. Okay, and we've created some kind of some newer sections. Here's some bite-sized content, which are shorter videos, and I've been working on a series of some quick tips with Thinkorswim. Okay, so you can see 6 minutes, 4 minutes, 5 minutes. Okay, so showing you quick little things that you might want to do on your Thinkorswim platform. Now, Cameron, he's here today. He's got several in our most popular, and he also has some beginning type classes. Okay, start here using the Thinkorswim platform. Cameron's going to take you through, and you can see all these lessons outlined 1, 2, 3, 4, 5, so that you can take it in sequence if you would like to, right? Or maybe you're sort of comfortable, but you see something that catches your attention. You just want to go in, get to know it a little bit better. Of course, something we always show you is our playlist. If you're trying to catch up on a series, certainly go to the playlist and check it out. Okay, so helps you as you are trying to find content, the right kind of content you're looking for. All right, we only did one trade today. I'll show you the other chart that I was looking at. You just might want to take a quick look at it as well. And it was Nucor. It's a material stock, right? They do some mining. What was kind of interesting about Nucor, yeah, they did a 520 crossover. We're not looking at it for that, but it is, if I were to put the 10 moving average in here, it's following the 10 moving average really nicely. It was taking a nice bounce off that 10 period moving average. We'll look at, I say pay attention, look at that stock, see if it meets any of your type of rules that you might do an example trade on. We don't have time to put it in right now. I'll have to put it in after our class is over, okay? Just like you do to a one call vertical there. All right, you guys, that is it. You peppered Cameron with some questions. We're happy that you joined us here today. Let's get back here. Hope that discussion on volatility, price direction gave you a little bit better feel for these bullish strategies, which ones you might want to use in what scenarios. Okay, we're going to be getting into earnings season pretty soon here. We will probably filter a few earnings season trades in over the next couple of weeks as we get started down that path. All right, we've got a lot of trades to continue to follow up with that I'll keep track of that are in our example trade for this class for our option strategies. Appreciate you being here today. We'll follow up on this trade, our 520 crossover trades, as well as our other trades next week. If this was helpful to you today, go ahead, smash that like button. As far as the survey goes, if you'll just select on that link, fill that out on your way out the door. We always appreciate the time you take to do that for us. So thank you so much, you guys. Have a good evening. We'll see you bright and early in the morning at the opening bell. Bye-bye.